There's a financial scandal so massive, so systemic, that it makes every other banking crime look like petty theft. For decades, the world's largest banks rigged the price of money itself, not metaphorically, but literally. They manipulated the benchmark rate that determined the cost of $350 trillion worth of financial contracts worldwide, affecting everything from your mortgage to student loans to corporate debt. The scandal is called LIBOR manipulation, and when it was finally exposed, it revealed that the entire financial system was built on lies submitted daily by banks who had every incentive to cheat and faced almost no consequences for doing so. This wasn't a few rogue traders. This was coordinated fraud by the most powerful financial institutions on Earth. Here's what makes this scandal uniquely devastating. LIBOR, the London Interbank Offered Rate, was supposed to represent the interest rate at which banks lend to each other. Every morning, major banks would submit estimates of what they'd have to pay to borrow money, and those submissions were averaged to create the official LIBOR rate. That rate then became the foundation for virtually every interest rate in the global economy. Your adjustable rate mortgage? Based on LIBOR. Your student loan rate? LIBOR. Corporate bonds, credit cards, derivatives contracts worth hundreds of trillions, all tied to LIBOR. The banking system essentially asked banks to self-report the cost of money honestly, with no verification, no oversight, and massive profit incentive to lie. Predictably, they lied. And they didn't just lie a little. They manipulated LIBOR systematically for years to benefit their trading positions, to make themselves appear financially healthier than they were during the financial crisis, and to profit at the expense of everyone who had contracts tied to these rates. The cost of living for ordinary people was affected. Every debt payment you made was potentially inflated by their manipulation. Every loan you took out cost more because they rigged the system. Billions in fines were eventually paid, but no major executives went to jail. The culture remained unchanged, and the financial elite who orchestrated this fraud kept their wealth and positions. Stick with me, and I'll expose exactly how this scandal worked, who profited from rigging the price of money, and why replacing LIBOR with a new system doesn't fix the fundamental problem. Ready to see the biggest financial fraud most people never heard about? Let's reveal the scandal that proved the entire banking system is rigged. Let's start by understanding what LIBOR was, and why manipulating it represents control over the entire economic system. LIBOR wasn't just another interest rate buried in financial markets. It was the foundation rate from which virtually all other interest rates were calculated. Think of it as the price of money itself in the modern economy. Banks need to borrow from each other constantly to manage their cash flow, and LIBOR was supposed to reflect what that borrowing actually cost. Every day, a panel of major banks, Barclays, Deutsche Bank, JP Morgan Chase, Bank of America, and others would submit their estimated borrowing costs. Those estimates were averaged, and the result became the official LIBOR rate published for various currencies and time periods. The Sabio observer immediately sees the fatal flaw. The system was based entirely on honor. Banks self-reported numbers that directly affected their own profitability, with no requirement to prove those numbers reflected real transactions. It was like letting students grade their own exams and then using those grades to determine everyone's class ranking. The incentive structure was backwards from the start. Banks had massive reasons to manipulate, and essentially zero accountability for honesty. And because LIBOR served as the benchmark for over $350 trillion in financial contracts worldwide, even tiny manipulations could generate enormous profits or losses. Moving LIBOR by just a single basis point, 0.01%, could mean hundreds of millions in gains or losses on derivatives positions. This is why LIBOR control meant control over the debt system itself. When LIBOR went up, your adjustable rate mortgage payment increased, your student loan interest rate adjusted higher, corporations paid more to borrow, and the cost of credit throughout the economy rose. When LIBOR went down, the opposite occurred. By manipulating LIBOR, banks weren't just cheating on some abstract financial benchmark. They were directly rigging the cost of borrowing for hundreds of millions of people and thousands of institutions. Your mortgage payment, your credit card rate, your student loan burden all potentially inflated because banks lied about their borrowing costs to maximize their trading profits. The financial elite had their hands on the levers controlling the price of money, and they used that power to extract wealth from everyone else. But understanding how they actually manipulated it reveals just how brazen this fraud was. Now let's expose exactly how banks manipulated LIBOR and why it was so profitable. The scheme had two main flavors: trading manipulation and reputation manipulation, both of which reveal the banking system's complete lack of ethics. First, trading manipulation. Banks have massive derivatives desks that place bets on interest rate movements. These traders hold positions that pay off if LIBOR goes up or down. So traders would simply walk over to the colleagues responsible for submitting their bank's LIBOR estimate and ask them to submit a higher or lower number depending on which direction benefited their trades. Internal messages revealed in investigations showed traders literally saying, "Can you set LIBOR high today? I have a big position that needs it." And the submitters would comply, no questions asked. This wasn't subtle or sophisticated. It was blatant fraud coordinated through emails and instant messages that investigators later found. Traders at different banks would even coordinate with each other, sharing information about what rates they needed and agreeing to submit numbers that benefited their collective positions. The financial manipulation was systematic and involved dozens of traders and submitters across multiple major banks. They treated LIBOR like a toy they could adjust at will to generate profits, completely ignoring that this benchmark affected trillions in real contracts held by pension funds, municipalities, small businesses, and ordinary people. Every time they moved LIBOR to benefit their trades, they were stealing from everyone on the other side of those contracts. But during the 2008 financial crisis, an even more insidious manipulation emerged. Banks started submitting artificially low LIBOR rates to hide their financial weakness. LIBOR was supposed to reflect what banks would pay to borrow from each other, so a high LIBOR submission signaled that a bank was struggling, and other banks saw it as risky. During the crisis, when banks were desperate to avoid looking weak, they systematically underreported their borrowing costs. They lied about LIBOR not to profit from trades, but to avoid panic and bank runs. This means that during the worst financial crisis in generations, when accurate information was most critical, the benchmark rate underpinning the entire economic system was deliberately falsified to hide bank instability. The central banks knew, regulators suspected, but the game continued because admitting LIBOR was fraudulent would have collapsed confidence in the entire banking system. The financial elite protected each other while the public remained in the dark about just how rigged the game was. And when the scandal finally broke, the response revealed how untouchable these institutions really are. Let's examine what happened when LIBOR manipulation was finally exposed. Because the aftermath proves that the debt system is designed to protect the financial elite, no matter how egregious their crimes. Investigations revealed manipulation going back to at least 2005, involving virtually every major bank on the LIBOR panel. The evidence was overwhelming emails, chat logs, testimony from dozens of traders and submitters, all confirming systematic fraud. Global regulators imposed billions in fines. Barclays paid $450 million, UBS paid $1.5 billion, Deutsche Bank paid $2.5 billion, and fines kept mounting across banks worldwide. By the time settlements finished, total penalties exceeded $9 billion. That sounds like serious accountability, right? Wrong. Here's the reality. Those billions in fines were paid by the banks themselves, meaning shareholders took the loss, while the executives who presided over this fraud, the traders who executed it, and the senior management who enabled it, almost all kept their positions, their bonuses, and their freedom. A handful of mid-level traders were prosecuted, and some served brief prison sentences, but the financial elite at the top faced essentially zero consequences. The CEO of Barclays resigned but walked away with millions in compensation. Senior executives at other banks remained in place. The banking system treated this as a cost of doing business rather than criminal fraud, and regulators allowed that treatment because prosecuting the banks too aggressively might have destabilized the financial system that regulators exist to protect. And the solution to LIBOR manipulation reveals how little actually changed. In 2023, LIBOR was officially retired and replaced by SOFR, the Secured Overnight Financing Rate, which is based on actual transactions rather than bank estimates. This sounds like reform, but it doesn't address the fundamental problem. The same banks dominate the same markets with the same incentives and the same culture that produced LIBOR fraud. SOFR might be harder to manipulate in the exact same way, but the banking system's willingness to rig markets for profit remains intact. The wealth gap continues expanding, economic inequality grows, and the cost of credit still flows through institutions that proved they'll cheat whenever they can profit from it. The LIBOR scandal should have been a wake-up call, that the entire financial system is rigged against ordinary people. But instead, it was treated as a technical problem fixed by tweaking the benchmark calculation. The financial elite learned they can commit trillion-dollar fraud, pay a few billion in fines from shareholder money, and continue business as usual. That's not accountability. That's confirmation that they're above the law. So there it is, the LIBOR scandal exposed in all its criminal glory. For over a decade, the world's most powerful banks rigged the price of money itself, affecting $350 trillion in contracts, inflating your borrowing costs, profiting from fraud, and hiding their financial weakness during the crisis. When caught, they paid fines that sound large but were tiny compared to profits generated, and virtually no one responsible went to jail or lost their wealth. The system that allowed this fraud has been tweaked, but not fundamentally reformed. And the same institutions with the same culture still control the global economy. The question you have to answer is uncomfortable. If the banks will rig the price of money itself when they can profit from it, what won't they rig? Your mortgage rate, your credit card terms? Your student loan costs everything. Flowing through the banking system is potentially manipulated to extract maximum wealth from you, while generating maximum profit for them. The LIBOR scandal isn't an exception that proves the system usually works. It's confirmation that the system is designed to benefit the financial elite at everyone else's expense, and that even when caught red-handed committing fraud on a global scale, they face no real consequences. Here's what I need you to do. Look at any variable rate debt you hold: mortgages, student loans, credit lines. Research whether those rates were tied to LIBOR during the manipulation period, roughly 2005-2012. If so, you were potentially overcharged for years, and while banks paid fines to governments, you got nothing back. Calculate how much extra you might have paid if your rate was inflated by even 0.25% due to manipulation. That's wealth stolen from you by fraud, and you'll never get it back. Sit with that anger, because righteous anger is what motivates change. And if this video opened your eyes to the LIBOR scandal and what it reveals about banking system corruption, if you now see that the entire economic system is rigged by the same institutions that claim to serve you, subscribe to this channel right now, because the next video goes even deeper. I'm going to show you how the 2008 financial crisis wasn't an accident, but the inevitable result of the same fraud culture that produced LIBOR manipulation, and why the next crisis is being engineered right now. The scandal never ended. It just evolved. And understanding that is your only defense.